Today on 10-Minute IT Jams, we welcome back Paul Adams, who's the CEO of Everedge. Today, Paul joins us to discuss what the top 5 risks are to your most important assets and why understanding these is so important. Thanks for your time again, Paul, and welcome.
Thank you. Thanks very much.
So just to start off, can you give us a little bit of a recap on who Everedge is and what you do?
Sure. So Everedge is an intangible asset specialist. So we like to say we work with all the assets inside of the business that you can't drop on your foot. So those are things like data and confidential information and brands and trade secrets and relationships and regulatory approvals and product designs, those kind of things. We started out life here in New Zealand, but most of our activity is now offshore. So we've got offices in Singapore, Charlotte, North Carolina, Sydney, and New Zealand. We've been around for 14 years, completed over 2,000 client engagements. Our net promoter score is plus 74%, or equivalent to a client satisfaction score of 9.44 out of 10. And we've been ranked amongst the top IP strategists globally for the last 9 years consecutively, and nobody else anywhere in Asia Pacific has ever achieved that level of accreditation. And we work with everybody from Fortune 100 companies all the way through to startups. And basically what we help them do is to figure out how to take their intangible assets and make money from them.
Fantastic. And so now speaking about intangible assets, what are the top 5 intangible asset risks?
Sure. Well, I think the starting point is really to understand quickly why intangible assets are important. And then we're going to drive straight into those risks. I'm just going to share my screen here so you can get a sense of what I'm talking about. So if we go back to 1975, intangible assets counted for barely 17% of all company value. Now it's over 90%. And so they're really important. And those intangible assets are everywhere. So when we talk about risk to intangible assets, we're not just talking about one kind of intangible asset, like say patents or trademarks, but actually there's lots of different kinds of intangible assets, and they all have attendant risks associated with them, right? So we're talking about things like confidential information, systems and processes, data, software code, regulatory approvals, all of those things. And what's important about these assets is that they are now the primary drivers of virtually all company performance and growth. So not only are they 90+% of all company value, but they're where virtually all of your company's growth is likely to be coming from, is out of these intangible assets. And most businesses have them, right? So if you went out to the industrial zone in any country around the world or city around the world, picked up a small manufacturer, they'll say, hey, we don't have intangibles, but actually they do. They're entirely intangible. And then if we talk about tech companies, they're very much the case, right? They're completely intangible in character. Now, as I mentioned, every asset has risk associated with it, right? So if you own a house like this, it can burn down. If you own a car, it can be stolen. Well, things like intangibles, data, confidential information, brands, etc., they all have risks associated with them too. So what I'm going to quickly run through is the top 5 intangible asset risks that you should be aware of. And it makes sense basically that given that these assets are 90% of your value, that's where most of the risk is today. So these top 5 risks, each one of them, let's have a look. The first is that most companies leak like a sieve. That's our experience. Most companies are constantly leaking key intangible assets. And there's 3 primary sources of leaks: out through customers, out through suppliers, and out through employees. And the consequence of this is competitive edge erosion, margin pressure, and material value loss. You end up like a hamster on the innovation wheel, trying to innovate and stay ahead of your competitors when you're constantly losing value. And I'll give you a good example of this. This was a company that I worked with. They developed a world-leading new product category. They're unable to keep up with the demand, and they outsourced the software development to an external supplier. That supplier delivered the product on time and in full, and we thought, great, let's use them again for version 2 of the release. We did use them again for version 2 of the release, or we went to, and they'd vanished, couldn't find them. And they turned up about 6 months later as a major competitor to us with over 25 million euros in venture capital in their back pocket. And when we looked at what had happened, we realized that one of our medium-level software engineers had taken our entire code base in the days where you still copied it onto a CD and FedExed it to them and given it to them. And what they'd done is they'd taken that and shifted jurisdiction to another country, started a new company, and got started. And because essentially what we've done is given them our most valuable asset, our entire code base. And that represented tens of thousands of person years of engineering effort. And you think, well, how could that be possible? Well, Reality is, it was never thought of as an asset. It didn't really register to people as an asset. And the consequence of which, that supplier, that company that we essentially jump-started into the market, grabbed majority market share and cost us over $150 million. The second key risk is this one. About 8 of the 10 companies we see cannot even prove they own their intangible assets. So unlike tangible assets, physical assets, intangibles are very hard to inventory. They're not registered. Typically, they do not appear on your balance sheet or your P&L. So companies get involved in joint R&D or contractors or supply agreements, employment disputes, restructures. They all lead to what are called chain of title issues. In other words, you can't prove you own your intangible assets. So I'll give you a quick example. Here we had a high growth fintech company who was raising a $36 million Series C at 120 million pre-money. Investors, when you do these kind of deals, they're going to ask you to sign a standard warranty. And that warranty is you own all your assets. Just like if you buy a house, when you're going to buy a house, or when you go to sell your house, you have to warrant you own your house. And so the investors asked these guys to prove it. And unfortunately, they couldn't. And they'd never bothered to track their chain of title. And when you looked at what had happened, there were 3 founders and they'd worked for a year unincorporated. And then one of them had left. So straight away, you had a split in the code. And then they had various friends and family come and work, and none of it was properly, none of them were properly contracted. None of it was properly recorded or written down. And then they had an employment dispute. Key software developer left, and all the time they're using open source code. And so you just ended up with this Gordian knot of code. Nobody could prove who owned what. And in the end, the investors said, well, if you can't prove you even own your code, why should we put $36 million in? So the company failed. The third key risk is that, software, as they say, has eaten the world, and 80% of all software code is now open source code. That's fine, except for 3 issues. Open source code presents 3 risks. Number 1, who owns the code? If the code's been written by some guy in his mother's basement in Bulgaria, do you really own your code if 80% of it's written by that guy? Number 2, there are very toxic license terms that can be associated with roughly 40% or 45% of all of the open source code licenses. And third, it's a very common way of getting malicious code inside of an organization. So open source code is a big issue. So here we had a private equity firm that we're working with that had invested into an industrial company. It looked a bit like this, right? A lot of stainless steel and things, and it didn't look like it was about software. But actually, when you really dug underneath the hood, the core asset of this business was actually the software. Conventional due diligence detected no material risks for this business. And so the investor invested. When we got involved, we realized that they had extensive use of open source code software. They had substantial licensing issues and cyber liability issues in that company's core asset, which was the software. And in this case, the investment was not small. It was over 100 million. So this investor had put $100 million into a business whose core asset, the software, was actually compromised. Fourth key risk, half the companies we see don't own their brand or have major brand infringement risks. So you find a lot of companies have very poor trademark strategy. They have changes in their market, their product, or their geographic coverage lead to no or poor brand or trademark protection. And so as a good example of this, we were working with a very fast growing company. They were spending $1.5 million a month marketing to build up their brand and their customer base. And they're planning to leverage that brand into a major offshore market, the US. When we sat down with them, we said, is this your brand? And they went, yeah, no, that's it. And we said, well, okay, you've got 2 problems. Number 1, that brand is not very well protected. You have what's called a device mark, not a word mark for your trademark, and that means you haven't got much protection. Secondly, and more importantly, you're about to expand into the US, and your brand, the word mark, is actually owned by your competitor in the United States. So in other words, you can't expand in the US with that brand. That was really problematic for these guys because they had spent now over $36 million building a brand they fundamentally didn't own. And the final risk is this one, getting sued, in short, what we call FTO risk, freedom to operate. And a lot of technology companies are exposed to this risk. So there's been a huge growth in IP litigation in the US and EU over the last decade. And basically, the more successful you become, the more likely you are to get sued. It happens a lot more frequently than most people think. You get sued by companies who own technology rights that are superior to yours. And the consequences are pretty significant. Injunctions, product seizure, recall, massive litigation costs and damages. So to give you good example of this. This is an award-winning hardware company we work with. They developed this great new technology, but they never understood their own intangible asset risk. Some VC firms invested into them. Again, no intangible asset due diligence, never understood that risk. They then did a deal with a very large US customer. And under the terms of that agreement that they signed, they indemnify that US customer for any and all IP infringement, which was crazy because they had no idea about the level of risk they were running. That deal essentially amplified or magnified their risk. And the inevitable happened. Their competitor found out what they were doing and sued their customer. The customer said, well, you need to go and talk to our supplier. And so the competitor came down to New Zealand and said, look, this is how it's going to roll. We're going to either sue you out of existence or you can sell to us for about 1/3 of your value. And that's what ended up happening. They ended up actually selling for about 1/3 of their value, and it generated a $100 million loss to the investors. So those are the sort of 5 key intangible asset risks that we see every day with companies. If you can avoid those 5, you've avoided most of your problems around intangible assets.
Fantastic. Thank you so much, Paul. That's very insightful. And I know lots of businesses out there will be looking for that kind of sage advice. So thank you.
Cool, pleasure.